Good morning, everybody. Welcome back into the Mining Stock Daily long form episode for this week. And it's a good one because we are going to talk all things commodities and really what might light the fire underneath a renewed commodity run. And so who better to talk about that than Mike McGlone from Bloomberg Intelligence. He puts a lot of scenarios out on the table in the next 40 minutes or so, talking about what it's going to take for commodities to start picking up. And why is maybe gold outperforming all the commodity sector, along with oil? I guess you might throw that into the basket here in the last couple of weeks as well. But while the base metals and the grains and the rest of the sector just continue to lag. So great conversation with Mike. There's a lot of scenarios out there, especially as we got a little bit of economic data this week to go along with it. Special thank you to Visa Silver, Arizona Sonoran Copper, and Fireweed Metals for their continued support of the podcast. And we will also ask you to hit that like, subscribe, and provide any feedback and comments within the YouTube channel or also in the podcast networks where you receive the audio version of these episodes. All right, so let's jump into it. My conversation with Bloomberg's Mike McGlone. Have a great weekend, everybody. Be well. All right, you're in this week's long-form episode here on Mining Stock Daily. We're going to go back to our roots, and we're going to really focus on the commodities sector within global markets. And it's been a while since we've had Bloomberg Intelligence's Mike McGlone. He's a Senior Commodity Strategist over there. It's been a while since he's been on the podcast, and so I pinged Mike a little bit ago, and we were able to get this on the schedule. So, Michael, welcome back. How you been?
I'm good, and thanks for having me back, Trevor.
Yeah, interesting times we are living through. I wonder if they never ever not say that. Like, oh man, this like era is really boring.
Yeah, I'm afraid when you say interesting times, you look at things like the VIX Volatility Index, 200-day moving average at a 6-year low. That means they're going to get much more interesting. It's a question of time.
Yes, no, absolutely. And I do want to talk about the seasonality of volatility that we found ourselves in here as we close out the summer and into the fall. That's, adjusted. That's usually a pretty volatile time here as we get into those fall months. But I do want to ask maybe in a general sense, and I want to kind of cut the tape here on PPI we saw this week. We're going to talk gold. I want to talk oil. There's a number of things within the commodities complex I want to pick your brain about. But maybe let's just start on the general sense here. I mean, the Bloomberg Commodity Index, which is, a general kind of, breadth of where people like to watch if this thing's actually getting traction. It certainly feels like it's been stuck in the mud here throughout the summer. Talk about this kind of these deflationary forces within the commodities complex. What's been the driving factor of it all? And was this something of somewhat of a surprise as we are now more than halfway through 2024?
Well, I want to follow up with that. You made me think of the nickname I earned last year was Mick Gloom. And in some ways, I've been early. I'm being bullish gold and bearish crude oil. But I like to say it's mixed facts. So let's talk about the facts first. The Bloomberg Commodity Index is basically unchanged on the year. That's a spot index. It was up about 12% to the peak. On a one-year basis, it's down about 5%. Gold's up about 30% on a one-year basis. On a two-year basis, the Bloomberg Commodity Index is down about 20%, and gold's up much more. That is a deflationary trajectory. You look at the Bloomberg Industrial Metals Spot Index. It was up almost 24% in the year. Now it's flat. Copper is still up a little bit, but it's reverting lower. And the whole trend in commodities to me is towards a global deflationary recession. Now that's just the trend. Now maybe it'll reverse. Maybe it's false. Maybe it's false indicated, but you overlay that with the extremely inverted U.S. Treasury yield curve. You look at things like the U.S. stock market. It's probably on a market cap to GDP basis. It's most expensive in my lifetime. We mentioned earlier, volatility in the U.S. stock market is at a 6-year low, 200-day moving average on the VIX, and everything's starting to roll over. The VIX is just starting to turn back upwards, and maybe the stock market's just having a normal correction for a bull market, still in a bull market. So from a commodity standpoint, I see the risks are we're going to head towards more acceleration of these trends, meaning commodities heading lower. They're just reverting that massive rally to the peak in 2022 and continuing strength in gold. The one problem is gold's getting a little stretched. And you know what happens when stock markets initially go down? People sell what they got. Now, that's what we saw on Monday, August 5th. We're taping this on August 14th. Everything's recovered. But I think we're starting to tilt towards a global deflationary recession. I'll end with one key indicator I've been watching for quite a while, and that's CGBs, Chinese government bond yields.
Mm-hmm.
2.19% is the 10-year note yield in China. And everything I see from my colleagues and BI China and NI China is the government's trying to push those yields up. If there's such a flight to quality, they keep dropping. It's a sign of deflationary forces are the second largest economy in the world.
I'm glad I did see that headline. Some of the talking points on the Bloomberg television the last couple of days. But talk about the U.S. bond yields as well. I mean, there's been a lot of buying with that. The high volatility. There's a lot of buying coming into the front end of the curve here. And all this is on back of maybe the expectations of interest rate cutting here. And we'll probably get into expectations of a quarter or a half a point here in September in due time in the conversation, Mike. But let's talk about just like this massive move to that flight to the least risk assets in bonds. And if there's any correlation you are seeing in the commodities sector outside of maybe the move in gold.
Yes, to me, commodities are in a normal deflationary cycle following a
Mm-hmm.
significant inflation. Commodities always get too hot and then they go to too cold. They're in that too cold cycle right now. And the U.S. bond yields, the longer end of the curve, is picking up on that. But first, let's look at facts. I just pointed out China. It's about 180 basis points less than the U.S. If you look at the average of the 10-year yields in the top 5 countries in the world, China, Japan, Germany, UK, and India. The average of their bond yields just a few months ago was 100 basis points above the U.S. 10-year note. So when people say the U.S., I'm sorry, below the U.S. 10-year note, the rest of the world is tilting towards the recession. U.S. 10-year note yields are still very high. Fed funds, as we speak, at 5.33% in the middle, are extremely high compared to PPI, CPI, and Chairman Powell said they are restrictive. Now think we're starting to see the delayed reaction of all the data is starting to turn downward. Now we've seen the latest hype about U.S. unemployment. It's bottoming from 3.4. It's at 4.3. It's just kicking into an upward trajectory. On 100% probability since 1947, it's never bottomed from such a low level without going to 6%. Okay, maybe it's different this time. But then you look at things that we have a metric on the terminal I really enjoy called the Economic Surprise Index. It's the lowest, means we have the most negative economic surprises on a measured basis in about 10 years. So all the data is tilting that way. Now we're seeing inflation data come out a little bit better than expected. But I say, what do you expect in a recession? Inflation, people curtail their spending, inflation comes down. And as time, we'll have to see what retail sales says. That might be a key flip for this week. By the time you hit the tape on this, we'll see. And my suspicion is I'll just point out the facts of retail sales, as I've been pointing this out for a year. U.S. retail sales look good, but if you inflation adjust, CPI adjust them, they've been as negative as just before the great financial crisis and just as we entered the big stock market plunge in 2000 to 2002. So all my indications are towards global deflation. And here's a couple of metrics I also mentioned too. Demand for diesel in this country is on a downward trajectory akin to the great financial crisis. Paperboards, container boards, demand is on a downward recessionary trajectory. And even unleaded gas is all heading lower. So from my standpoint, from a commodity standpoint, I see recession. I see the U.S. bond market just starting to kick in. And we're completely dependent on that U.S. stock market staying higher. So if it tilts lower, those are deflationary forces
Mm-hmm.
worthy of the inflation we got to the 2022 peak kicking in. And I think that's where we're heading.
Mike, it wasn't too long ago, before there was even talk about a rate cut, when we were north of this 5% Fed funds rate, there was question whether if that high of rate was restrictive enough. And here we are. It didn't take long, and all of a sudden we're having the discussion and debate if it's overly restrictive. We saw a lot of economic data kind of start cutting through the cracks here since then. I mean, you sound like you got something to you want to piggyback on that.
Well, exactly. That's the thing I've been seeing. I've been early. Some people would say I was wrong. I might have been stopped out on the way in crude oil on the way up, but it's been going towards 50, which has been my target. I was way early on gold. It's finally heading towards 3,000. It bumped up against 2,000 for 3 years. People who've listened to me for the last 3 years, so no, I've been, yes, early on that. But this is what also I think we have to understand the quote I've been wanting to write a headline for a while, that push out, ignore the models, look at the history of markets. And I've been really catching up in the history lately, in the history of massive pumps in liquidity and massive reciprocal pumps in asset prices always revert downward. Now we're seeing that happen in a normal way in commodities. The Bloomberg Commodity Index is down 30% from its peak in 2022. At the same time, gold's up 30%. So that's a normal trajectory. They just haven't gotten cheap yet. Natural gas kind of got cheap. Corn is pretty much getting cheap below $4. It's down over 50% from its peak. And the problem is I see right now is this is global. It's significantly in China. I mean, what country is not trying to push back on all the cheap renewables, EVs, solar panels, storage, batteries from China? They all are. The latest is you can get a decent plug-in hybrid from China that gets almost 1,000 miles on a single charge, and it's almost half the price of an equivalent vehicle in the U.S. I mean, I have a Chevy Volt. I've had it for 10 years. It's a great vehicle, but that's just a significant repressive force. Now, I think the key thing is to remember cycles. One thing it's really delayed, I think, the normal signal you get from an inverted curve, which is recession, is a significant amount of fiscal spending. We all know 67% of GDP, of deficit spending has only been matched in history during wars and recessions. So that's keeping things bid. But I think everything's starting to tilt back to that recession. Remember that pendulum that swung way too far over a year ago to recession, and then just a few months ago swung way too far away from recession, simply tilting back. And the thing is I want to really be concerned about, it's the effect of and the repercussions of a delayed reaction. So from commodities, I see nothing but global recessionary trajectories and deflation. And the one thing that's holding up is the U.S. stock market. So if we have a little bit more of just a normal reversion, everything tilts lower, and it's a question of when the Fed will start easing. But then again, remember what the Fed did. They went up on the elevator, some of the quickest hikes in history, partly because they were way far behind. And it's more likely because of this high inflation, because of elevated liquid risk assets, unless they go down hard, they're going to go down slowly with rates, is the way I see it.
You mentioned that, gold's relation with the Bloomberg Commodities Index, and despite gold being up 30%, the index has been hit pretty hard. But we could have like that virtuous discussion here. Is that because gold's more of a monetary asset, less than a tangible commodity? Should it even belong to that index?
It's a good question. I actually used to run both the Bloomberg Commodity Index and the S&P GSCI when I was at S&P. Now it's obviously a Bloomberg Index, but it's the most investable commodity on the planet. But it is really more of a store of value and the best measure of valuation over time in history. I mean, if you want to measure the value of farmland in Indiana or the S&P 500 over 100 years, going to gold is the best way versus dollars. Sure, it's always going up. The amount of dollars are just, certainly since the financial crisis, since COVID, we pumped in so much money in the system. Assets will always go up in terms of the inflation of fiat currencies. But gold, to me, the key thing to remember about gold is the inflection point for gold for me was 2022, the unlimited friendship between President Xi and President Putin. It shifted the world order back from what we have had significant détente for about 30 years since the collapse of the Soviet Union. Completely shifted the other way. We've had the invasions of Russia and Ukraine. We've had more and more Middle East violence, but the whole world is shifting away towards a Cold War 2.0 and it's getting hotter every day. And that is nothing but good for gold. It's nothing but, to me, bad for China and bad for broad commodities, i.e. copper. That's the macro that's kicking in. And the key thing is to remember gold is the deepest pockets on the planet have been buying gold for almost 3 years now. Central banks, China's leading the way. And ETFs, we've seen selling from investors. It's just starting. ETF inflows are just starting to turn, outflows. They were going down. ETF flows are starting to turn inflows. And I think part of that is that mantra that why buy gold with the stock market on the tear and US T-bills at 5% is reverting. And that to me is going to bring more and more flows to gold. Now, initially, if the stock market drops like it did on August 5th and like it did in the financial crisis, gold will be pressured because it's up a lot and people have to hit bids. But overall, to me, that's the thing that's shifting favorable towards gold and still unfavorable for most commodities, particularly crude oil. I'll end with this. The key thing to remember about commodities in the long term, the lessons of Adam Smith, they always revert to their cost of production, depends on where and how long. And natural gas has. Gold, the largest producer and net exporter now of crude oil in the world is U.S. and Canada, and the average cost of production is about $55 a barrel. And right now, as we speak, in WTI, it's 77. So I think it's supported for now, but it's eventually going to get there to shut off that excess supply and demand out of the U.S. and Canada, which is part of the deflationary forces, but it's also part of the strength for the dollar.
Yeah. Okay. How about the dollar? There's a lot of people who are kind of waiting from the sidelines, looking to really make a move and buy commodities, thinking that there's a cycle among us, but it's kind of all hindering on a downward trajectory in the dollar. So give me a sense of what might spur a move down in the dollar. How much lower does it need to go to really get the commodity sector back on track?
Stock market. Unfortunately, let's talk about mixed facts. The facts of the dollar strength, certainly since the bottom around 2011, if you overlay the U.S. stock market with the MSCI ex-U.S. index, it's an all-time high. Now, that's 35 years of data we have on that. U.S. stock market outperforming the world has been part of the dollar strength. Once that reverts, you're going to see a little dollar weakness. I mean, maybe it'll happen different this time, but that's part of the lose-lose for risk assets. The U.S. stock market is just so expensive. But that's part of what's been driving the dollar. And then I also like to point out is, okay, you still get 5% US T-bills. And compared to a basket of currencies, or trade-weighted currencies, there's nothing even close to the dollar. Maybe the euro is a 5 on a 1 to 10 scale. China's not even close. I mean, you can't even, there's no free flow capital, no discourse. I mean, I can't go and buy Chinese CGB or it's unstoppable. Now, I think the dollar is going to continue to depreciate versus gold. But versus a basket of trade-weighted currencies, people have been looking for it and asking for it. I said, yeah, good luck, because when that happens, it's probably going to be pretty bad. And there's also one thing that's been one of my key signals, other than the underline of U.S. The soundness of the U.S. system, which sounds dicey, but it's checks and balances that people forget, the military and all that, in a period of escalating Cold War. It's cryptos. And a lot of people think that's silly when I say that, but this is the most advanced new technology on the planet. And I've been pointing out for 5 years, as the base layer, people keep thinking of a Bitcoin. The number one traded crypto is the dollar, Tether. So the whole space has gone for the dollar. The world has organically gone for the dollar through cryptos, which just shows the underlying strength of this fiat currency that might be getting better. We've learned the lessons of too much inflation, but I say be careful with those who've been pushing. At some point, yes, the dollar needs to correct and pull back against a basket of currencies, but maybe one or two currencies will do better. But in the long term, I do like to point out what Jamie Dimon said when the dollar was recently downgraded, and the few currencies that had better ratings than the dollar were all under the protection of the U.S. military. So it's kind of silly.
How much of a correction would we need to see if we just took the S&P? I mean, we saw a meaningful dip here, almost touching its 200-day moving average. Had a little bit ways to go to touch that, but below that 5,200 mark last week, I believe it was, on that heightened day of volatility. It's crawled back up here, but how much further down would it need to go for people to really begin that meaningful rotation away from U.S. equities and into commodities? Would it be a 20%, 30%?
Well, I would say good luck going from equities to commodities when beta goes down. That's the problem I have to point out right now. First, I'll answer your first question. I think all the algos and everything kick in when the S&P 500 starts tilting below its 200-day moving average. It's usually how that works. Bitcoin's already done it. And that's right now around 5,000, just above that, and stays and starts turning that 200-day moving average lower. Now, you've seen the opposite in bonds. Bond yields like treasury bonds, TLT, have all turned back upwards. And and the fastest horse in races turned down Bitcoin, and the S&P 500 is still hanging in there. But I think you need to have a sentiment shift. The problem is when beta goes down, everything goes down. So to get um, a broad allocation, expect commodities to go up if beta is reverting from its highest measure in terms of market cap to GDP since the 1920s and 30s. You have to expect severe deflation. So that's what I'm worried about right now. It's been an inordinate burden of U.S. stock market to keep going up to lift all boats. It's not lifting commodities and everything, many things starting to tilt lower, like bond yields. So I look at it as just a normal reversion in the stock market, means severe deflation kicking in, which is very normal after severe inflation on the back of this significant money pumping. So that's the way I see it, is to get a shift towards commodities going up other than gold and stock market going down. You probably need some kind of event, seriously significant supply curtail event like we had with Russia's invasion of Ukraine. The problem is we're still in an overhang from that event. So typically it takes a while for things to work themselves out. So I see this as a lose-lose for most all risk assets except for gold and treasury bonds, most notably treasury bonds, if the stock market starts rolling over. And at some point you have to expect it too. So I'll end with this. I like to measure sometimes versus a 100-week moving average. The S&P 500 right now is 20% above its 100-week moving average. The all-time high, at least in the last 30 years, was 29% in 2021 when we had that massive pump in liquidity. Just in July, it was 26%. It's going to go back to that 100-day moving average, 100-week. I'm sorry, I'm talking weekly moving average. It's going to go back to the 100-week moving average, which is about 43. It's a question of time. 100-week moving average is still heading higher, so maybe it'll be higher. But this always happens in bull markets. It's just we're so stretched, people forget about it. You can really see that in how low volatility is. The VIX Volatility Index, the 200-day moving average, is the lowest since 2018. If you take out the T-bill rate out of that, which is one of my best indicators in 2008, before the financial crisis, the low was in 2007. And we're at those levels now on those metrics. So all the indications to me are normal reversion is what we need to expect in even stock bull markets. And the commodities are giving us a good indication for that to happen. And it's that gold versus everything ratio, gold versus industrial metals, gold versus copper, gold versus commodities, gold versus grains, that's signaling this is a global deflation or a recession kicking in. Something's got to stop this trend. Otherwise, I expect it's going to just continue.
Severe deflation on the back of an event, perhaps such as something escalating in the Middle East? Would that potentially have some?
I don't know what it's going to take. So if people are looking for escalation in the Middle East, so far crude oil has been somewhat bid on that.
Yeah.
But you need to have some kind of significant enduring curtailment of supply, which is very rare. Right now, if Iran is hit, okay, that's what hurts China. All Iran's oil is going to China. It's not a lot, 1 to 3 million barrels a day. That's up to 3% of global supply. Israel doesn't, produce any crude oil. It has to probably hit OPEC and Saudi Arabia. And if they continue, they're already the excess of the surplus of OPEC supply right now is around 6 million barrels a day, somewhat dicey. That roughly is equivalent to the excess of supply versus demand in liquid fuels in U.S. and Canada. You see, the problem there is keeping crude oil elevated is accelerating the trends that pressured it lower in the first place since 2008. And that's the shift. That's the paradigm shift from the U.S. being a net importer to net exporter. And it's accelerating. Still above the cost of production U.S. is an example of deflationary forces in commodities. So I don't know what it's going to take. Something, hopefully, unfortunately, nuclear maybe. But for now, the trend in commodities is you have to get to that lower price cure to make a bottom, which to me means probably 50 or below in crude oil, unless something shifts. In natural gas, we've only done it. So I like to point out the number one measure of heat, electricity, and fertilizer in this country, natural gas, it went up to 10 per MMBTU when Russia's invaded Ukraine. It's dropped down to 1.5. Right now it's 2 and change. It's a level that was first traded 30 years ago. I mean, that's severe deflationary forces there. And we need more and more natural gas for electricity production. But warmer winters, too, are pressuring a little bit of that demand.
Yeah, I think the way you're kind of laying this out here, Mike, it sounds like obviously a very volatile event or time period that would see another spike in volatility. There would be kind of that, blood on the streets, sell everything type of event. It was interesting. I was going back when you were talking. I went back because I remember looking at this last week. I was just kind of looking at the VIX chart. and those really big spikes in volatility, you know, the 2008s, the 2020s, and then last week. And what was interesting in that the GFC and during the COVID times, when that volatility spiked, it grinded lower, like slowly kind of the volatility deflated itself. But last week it was like spike up and then 2 days it was gone. You know, it was just like back to normal. And I don't know if that was a sign of like, I know there's a number of people that have studied the events of last week and kind of have some theories about exactly what happened on the back of the end carry trade and other things prove that caused that volatility. But it was almost like the mentality of the market itself as coming back over the last 4 years. It was the dip buyers, like, here's a great dip to be buying, get in while you can because numbers only go up. And so I'm wondering if that's more of like, you know, just kind of a mirrored effect of the stock market mentality, the gamification of what we've seen the last 4 years, or if there's maybe more to it, why we just saw a sudden recorrection into volatility back into the 16s.
I see it as a shot across the bow, and particularly mostly the sell side strategists who've been saying buy the dip forever have been right. And at some point, they're going to be wrong. It's when you get volatility the lowest and interest rates the highest in almost 2 decades. A lot of these people don't know what it's like when things normalize. I'm just talking about normalization of volatility. Right now, the 200-day moving average of the VIX at 14% is the lowest since 2018, and it's just starting to turn upward. So we had a little warning. As it turns upward, so that's the way volatility in markets always work. Volatility always goes down on the escalator and up on the elevator. Lessons of 2008. This is my signal. This is one of my best signals since in 2008, which helped me when I was a trader back then make a lot of money that year. It's just the mean reverting lessons of volatility and the mean reverting lessons of interest rates in the U.S., particularly as we tilt towards recession. So I think that's the normal human nature reaction you have to be careful towards is always buy the dip. And at some point, you just get too high. So I pointed out just this year, 26% above the 100-week moving average, and the S&P 500 was very extreme. That's the most, with the exception of the COVID, in over 2 decades. So you don't want to be the first buyer up there. You want to wait till it gets maybe, and we're still very stretched on that basis. And then you look at the U.S. stock market versus commodities. It reached the highest in about 25 years. That's about the Bloomberg Commodity Index versus gold. It's the highest since 2007. That's the problem. Just getting a normal little bit of reversion in this overextended market will have profound implications, I think, for all assets. And to me, that's what the gold market's picking up on, and the weaker stock and weaker commodities. But it's also happening on a global scale with issues happening in China. Now, China's way overdue for a little bit of normal reversion of a rapidly emerging market. It's just starting to kick in, like their bond yields. So I look at when we've had a little shot across the bow, but be very careful calling for buying dips when the curve is just starting to invert after 2 years. Right? That's the lesson of that. Unemployment is just starting bodying from a very low level. It never stopped until 6%. And you have things like, I like to look at the fastest horse in the race. Bitcoin's been showing pretty significant failure since March. It's heading lower. And to me, all this is heading this way. So one of the key things I've been watching, I mentioned, is China bond yields and the U.S. yield curve and U.S. bonds. U.S. Treasury long bonds looks like they're just catching up. So I do enjoy the narrative that, deficit's too high. It is. I've just been hearing that I've just been hearing that since the late 80s when I started in the bond pit. And it is too high, but compared to the rest of the world and compared to alternatives, it's always been a sign of yields going lower, and people point that out. So the Fed's just going to start easing. Inflation's still sticky, and it's the macro that matters, and that's where I'm really worried about. I'll end with one key thing that was a good indicator this year was copper. Copper had a good reason to make a new high. It went up to $5.20, and it was a classic sell signal. I wrote about it. I was a little bit late, but it was managed money net positions, i.e. futures. Speculators got the most long copper versus open interest. I think it was around 35% of total open interest was speculative longs. in about 5 years. It put in that high peak around 520, and now it's down around 4. I think and they're still net long around 20% of open hits. There's typically bottoms in copper come around 5%. Now that's just the technical things, but they're driving the macro that copper is going to do great with electrification and decarbonization, and China in expanding and recovering makes sense in the long term. But China is not; it's imploding. If you look at its bond yields. So to me, that indicator for industrial metals is very bearish. Copper's the number one. The key thing is it did make a new high versus crude oil. Crude oil didn't. So in the long term, it's going to outperform. But the doctor at $4 right now is it's still up slightly in the year, but it's well off that high, and for a good reason. I think the risks are that this momentum we have since like 2Q or 1H is going to continue downward for most risk assets, industrial metals, following Chinese bond yields. And the biggest risk is if the U.S. stock market continues to roll over. We'll just look over the commodities market and say, oh, thanks for the warning. And by the way, there's more pressure for all risk assets.
Severe deflation into a recession, it doesn't pose well for copper. And we've seen the manufacturing numbers come in. They're waning as well, I guess you could say, from that data. This shouldn't be much of a surprise, but, in the long term, there is, people that listen to this podcast, we do talk about that long-term fundamental supply-demand issue.
Sure.
And maybe kind of balance that with the copper trade, what you're seeing long-term, and you just kind of pose the, short to medium term here amidst of recessionary fears. But what does the long-term trend of copper look like for you?
Upward, of course. I mean, but certainly in terms of dollars. I mean, if you look at copper since 2000, the price right now around 4 was first traded just about in 2006, almost 20 years ago. It's a very autocorrelated commodity. And yet the difference with crude oil is it has been making successive new highs. A high in 2022 on crude was below the high from 2008. The high this year is lower, and you can see the trend, lower highs and lower lows for crude. It's just those lows are still hanging in there. Copper overall, I get it. Longer term, it should do better. It will. But right now, it's facing a pretty significant paradigm shift, I think, in the world. And that is the number one demand source for copper, i.e. China, if you look at their bond yields, is heading towards a pretty severe depression, maybe recession, okay for now. Of course, we can ignore that. Maybe they're wrong. But everything I read is the Chinese government is trying to keep yields up, yet there's too many buyers pushing them lower. Why? Because it's a flight to quality. So that I have to go back to that unlimited friendship. That shifted the world away from China. Now, people are talking about deglobalization. It's not really deglobalization. It's just every major country in the world that was doing business with China, particularly Europe and the U.S., its two top customers, are doing everything they can to get away. Because they're, according to the NATO, they are in decisive enabler of a war in their backyard in Europe. It's just, I can't wait to write the textbook about that. If you really want to hurt your chances with your customers, is start a war or support. Be a decisive enabler of their war in the backyard. So it's push against China. Imports, everybody's shifting away from China in terms of what right. That doesn't happen overnight. So that economy, which is having severe stress now. We see the headline I saw this morning on Bloomberg is China's loan drop stokes fears of a balance sheet recession. That's just normal. So for copper to be bullish on copper, you have to expect China to recover and or have a elongated period before copper can bottom and then go back to that upward trajectory. Yes, the decarbonization, electrification, but more significantly is this global tilt towards recession in China. And I'd like to point out is I got that name McGlone by pointing out facts of history. And the facts of history are, number one is what's happening in China was really covered in many books. One of them was Great Rupture by Victor Shivitz. One was another Price of... yeah, you probably have that up. The Price of Time by Edward Chancellor. Boom and bust. The whole history of the world in China is that they're just heading for a normal reversion of rapid expansion. So that's bad for copper. And then there's the U.S., way overdue for recession. You look at that inverted yield curve. It's been on a 30-year yield to Fed funds basis. We're the most inverted and the most, for the longest, since 1979, 1982. Now, I remember that recession partly because I was younger, but my father was in the steel business and he said it was very much like a depression. The signals are there. and you got to watch the doctor. So I like to overlay with the whole Bloomberg Industrial Metals Index. Like I said, it was up 24% in the year. It's wiped that out completely. The Nasdaq was up about the same. It's wiped out some of that. It's come back. The risks are that the equities follow that, and then you have the dominoes. But the key fact is in the history of I just like to point out the history of all these, the kind of liquidity we pumped in the system is the hangover may just be getting started. If history is a guide, it's just getting, and the signals are we've had a delayed reaction.
Okay. Well, Mike, and as you know, the older you get, the hangovers last longer and longer and are worse. But I'm glad you mentioned China, because actually this morning I listened into a webinar from S&P Global, and they were talking about the iron ore market. And how there's just not the demand coming out of China for iron ore, because, listen, for decades, the way the Chinese stimulated was by building things, which would demanded iron ore to manufacture. Now, if there's not enough demand out of China for iron ore, why would there be increased demand for copper? How can you put that on that country to, like, rising tide lifts all boats? And I've posed this question a number of times, probably the last couple of years, Mike. And maybe last time you and I talked, I maybe asked you the same thing. Wouldn't be surprised, but it just made me kind of go back and think again. All right, if we are going to have a renewed commodity cycle, let's say this plays out, we have severe deflation into a recession, things readjust and come back to their means. Can we have a commodity cycle, a bull commodity cycle that is solely on the back of China consumption? But wouldn't you see more of a global move of mass consumption as the economies continue to get their feet back underneath them?
Well, sure we can, but that's unlikely. We've already had that. That's one thing that's unique about human nature. Sometimes people forget when there's paradigm shift. The paradigm shift is away from that. And we've also had the biggest pump in the commodity market since Iraq's invasion of Kuwait. Some of us remember that. Crude oil went from 20 to 40. I was in the trading pits then, dropped right back down to 20, and didn't bottom until 10 in 1998. It's the same cycle right now. It's the same thing happened when the Iran-Iraq war. Crude oil popped up to 30 from 10, went down to 10 it was about 86. Mm-hmm. We're in the wrong side of the cycle right now to expect commodities to bottom, because we've had the event. If you weren't long the insurance before, we've already had the fire. It's a question of what can change and revert back upward. Typically now we're heading for that, either the low price cure, which natural gas has been an example. Corn's pretty close there, getting there now, below 4. It was above 8. Crude oil's a lagging one, but it's heading that way. Typically you have to get to that low price cure, or you have to be expecting some kind of event akin to Russia's invasion of Ukraine. But usually those are short-term. It's the long-term thing that matters, which means China, which means a weaker dollar, and means global demand pull sources. And that's not happening. It's the opposite. Mm-hmm. So we point out the dollar. It's typically you need a weaker dollar. So what happens with a weaker dollar? Friendly Federal Reserve. It usually the history of commodities is oftentimes they'll have a decent rally upwards after a long and variable lag to a significant period of Federal Reserve easing. Well, we haven't started that yet. Okay, so that's still like I pointed, the cycle is still towards that low price cure. I say copper proves you're better off selling rallies. Certainly, and crude oil's proved you're better off selling rallies. Corn has proved you're better off selling rallies until it gets stupid cheap. One thing that's really significant that's changed though is the market's on top of that. Managed money net futures positions on the broad Bloomberg Commodity Index about the lowest they are in our database going back 20 years. So the market is really priced for a bear market. Like you look at hedge fund positions in Brent, they're completely sold out. They're 1% negative. They've never been that negative in our 10 years of data. It's almost always positive. So that's the good news, is the hedge funds are sold out for now. Grains have reached record shorts this year in terms of percentage of open interest. So the right way to do it, not just contracts, but why? Because there's an excess of supply. And why is there an excess of supply? Because it's the back end of prices going too high. The high price cure is heading towards the low price cure. It's just a normal cycle. I reread Adam Smith's book in the section on commodities recently, and I really enjoyed how he mentions copper and gold and silver and corn, but not even crude oil. Crude oil didn't exist then. And now it does, but it's being replaced by technology. But it's the cycle that matters. And remember, we're on the wrong end of a typical cycle. The Fed has to let's look for a long and variable lag to Federal Reserve easing. Let's look at decent low price cure probably gets crude oil below 50, and or some kind of shock that I can't predict. That's what we need. Is we need some kind of shock that we've already had. It's only been just almost 2 years since that shock. Just look at the Iran-Iraq war. It took 10 years for bottom. That was and then it was Iran and Kuwait. It took Kuwait, Iraq. It's just those examples are bad for commodities when you get those pumps. It's the lessons of Jeff Booth. He wrote the book, The Price of Tomorrow. It's just technology is moving so fast. Those forces of elasticity in commodities, you have to expect them to be less powerful than they are in the past. And what we're seeing is proof that they're more powerful than they were in the past.
Mike, on the back of this, you mentioned basically the checklist of things you would need for this commodities sector to get moving again. Follow-up question on that. Rate cut, 50 basis point rate cut in September. How likely is that for you? I know the market's kind of, last I saw was like a 56% chance of a 50 basis point cut, 100% chance of a 25. But is that enough to get this thing going if Jerome Powell gets up there and says 50? No.
Well, I think we're so much priced for it. So I like to look at Fed Fund futures in 1 year, started pricing for 100 basis points of cuts in Q1 2023. That was over a year ago. We still hiked another 100 basis points in 2023. Now, I thought they were way too late. I was wrong. I thought they went way too far, but there's reason they did, because inflation's still sticky. And part of the reason it's sticky is because risk assets are so high. It's keeping sentiment strong. But according to the WIRP function and the terminal, you nailed it. There's a 100% chance they're going to go 25 basis points at September 18th. They might go 50. I think what's likely is they're just going to go 25 at each meeting, unless we have some kind of crisis, meaning risk assets go down hard, or some kind of credit crisis. Otherwise, they're going to be on a trajectory because inflation's still somewhat high. The problem is if they go more, there'll be a good reason, and I think the good reason is the stock market will tell us first. But that's where we're into that. We're lose-lose. I think the market's already priced for this easing for a number of years. It's just starting to get it and realize that we're going to need it, but it's the delayed reaction to pumping the system with too much liquidity, getting too much inflation, being way far behind the curve to start hiking rates, and now the whole thing is starting to cycle back downward. It's certainly happened in the rest of the world. Like I mentioned 10-year note yields, and the average of the 5 countries, top commodities in the world are still, they were, but now probably 80 basis points less than the U.S. 10-year note yield. They're all tilting that way. So the U.S. is a shining star. How much longer does that last? Of course, we have things like the election, but I'm just looking at normal cycles in markets. So that's why I keep using that phrase, inordinate burden for the U.S. stock market to stay strong, or else we tilt towards a normal deflationary period following the significant inflation to the peak in 2022.
Mike, thanks so much for your time. I really appreciate what you gave to us. There's so much to be paying attention to, but not only just the commodities, but geopolitics. It seems like every day where it could be wake up and the world's falling apart once again. But I appreciate all the insight, and your note every day is absolutely wonderful. It's a great insight for me to start my day. So thank you so much.
Thank you, Trevor. I appreciate being on, and looking forward to the next time and see how things shape up.
Yeah, I'm sure I'll run into you at one of these metals and mining conferences once again. That's Mike McGlone, Senior Commodity Strategist from Bloomberg Intelligence, everybody. And that's a wrap for us here this week on the pod. We'll be back Monday morning with the morning briefing. Have a wonderful weekend and be well.